Phil Smith is the National Director, Transaction Services of Colliers International. Phil is actually responsible for the largest transactions that take place in our sector, both across retirement villages and aged care. And it's a very complex role. He's got to bring two parties together, often across state borders, get a value for it the vendor is happy with, and then also get a purchaser who is happy with the proposition. He has achieved that on numerous occasions, usually 1 minute before midnight on Christmas Eve, which makes it doubly challenging for somebody like me. So, without further ado, I'd like to ask Phil to the podium. Thank you.
Thanks, Chris. Aged care I'm going to start with. It's been a really active sector, as everyone knows. 2014 saw 3 companies list. We expect 2 to 3 more could possibly list this year. And there's been the major regulation change basically has introduced and facilitated private funding on beds, which is really where all the operators are chasing their income streams from now. The major activity, Estia Healthcare listed late last year. They acquired Padman Care, 900 beds, Cook Care, 800 beds. Japara Health expanded into Adelaide, 280 beds. Ality bought the not-for-profit ECH in South Australia for 1,000 beds. Aurum, a new private equity, private money from one of the rich families in Australia. They entered the market with 300 beds in Central Coast, and I believe they've got another 200 beds in Victoria. Another group, Infinite Care, again private equity backed, new entrant in the market, bought 400 beds in Adelaide, and they've got 300 in development. And Opal joined with Stockland's some sort of arrangement where they've taken over Stockland's beds in Victoria and Victoria and New South Wales. The actions continued this year. Mackenzie have bought 700 beds from Embracer in Victoria, and there's rumours in the market Mackenzie may be the next one to go for a listing. The pricing driver and trends, and I often have fights with valuers on how things are calculated, but it's not simply an EBITDA model for aged care. Pricing now is including the bond uplift or the daily payment uplift. Those sorts of income streams weren't available last year, but they've been available from the 1st of July. But the big issue we're finding with a lot of transactions is buyers are conscious of over-bonding. Whenever they buy a facility that's got an accommodation bond balance, they have to get comfortable that it's maintainable and even that there's value to add. Facilities that are fully bonded, we're getting actually less appetite for. What everyone wants to know is the pricing, and look, I don't propose to do valuations. We transact. We don't actually have to report to banks, but I think there's probably 3 different categories. The modern aged care facility, single, ensuite, nice outlook. We work on a gross basis from 210,000, which is effectively the replacement cost, to anything over 300,000. It depends where it's located. Metro areas we can go 400,000, 500,000, but typically that seems to be the range on a gross basis. The older aged care facilities where multiple beds, shared bathrooms, not on very big pieces of land, so there's no real scope of brownfield development. The range tends to be 100 to 150. That's come up. A few years ago, we saw some transacting at 75, 80 grand a bed, but now we're, again, fully priced, or maybe not fully priced, we'll see how the market goes, but 100 to 150 is still a lot higher up than we were a couple of years ago. And the older homes that I just mentioned that have brownfield, so they have existing land, they're capable of redevelopment, capable of new wings, they're somewhere in between that range, which is a bit weak and a bit soft for me to say, but it's one of those things they can pick up something, run it, build new wings, get bonds in. So we've seen them trade anywhere from 150 to 170. So what does 2015 hold for aged care? Look, I think the next 2 years, there's no doubt we'll be seeing the smaller family groups exit the market. Most of our sales, we've had probably 4 lots of 300-bed portfolios sold in the last 12 months, and they've all been family groups who have said the compliance cost is too much and it's time to let the listed companies and the big boys take over and deal with Canberra. I expect that'll continue this year. There's still a lot of family groups out there anywhere between 100 beds to 500 beds who are really saying probably enough's enough. And I think the general feel is that you need a minimum 1,000 beds just to deal with the compliance issues that now aged care faces. The big challenge for aged care is finding development sites in metro areas. I think I've got every aged care operator in Australia asking me to find them land in northern Sydney that they can build an aged care on. But unfortunately, I get tapped on the shoulder by my residential colleagues who have a Chinese buyer ready to go. And that's a lot easier to fund, a lot easier to get off the ground, and they're high prices. So that's the challenge, is the older facilities in Sydney and metro areas is finding land just to rebuild. Retirement village transactions, this is a bit more opaque market, and it's not my fault, Chris. Basically, Lend-Lease, we saw purchase Retire Alliance and the price was undisclosed. Lend-Lease purchased Waterbrook Village, price was undisclosed. We had Baptists late last year buy Watermark in Wagga, the price was undisclosed. So valuing these things is really difficult. My valuation colleagues are always whinging. We do see the transactions, but those guys actually sign me up to confidentialities and take my kids as currency and threaten to give my kids back if I speak. So I can't do that. Colliers, we probably have, this is actually quite a low estimate, we have 20 either villages, MHE parks or aged care facilities basically under sales mandate at the moment. So anyone that's looking for something, let us know. But again, you know, whenever we run a process, it's completely confidential. We sign confidentiality agreements, and when it's done, it's pretty seamless. No one finds out until it's done, effectively. The trend, I suppose, in 2014 was that the villages that did transact were more mature than previously. 2013 and possibly before that, there was a lot of distressed stuff out there, part-built villages, development sales upside, and that's what the buyers were going for. But we found a move now to 2014 that they're going for the mature villages, so they are chasing the DMF. Discount rates, look, unfortunately we're not back at 2008 yet. You know, we're still in a range of the metro suburbia. We haven't seen 13% under, we haven't seen under 13% for a little while now. Everyone says turn off your mobile phone and mine's going, so excuse me a minute. The metro suburbia, 13 to 15% tends to be the discount rates. Look, we'd love to go back to the days where we saw a 12% at the start, but it's not going to happen soon, I don't think. Regional assets, look, it's very difficult to do a regional asset. You know, the demand's there for them, but you know, you're looking at 15%, but we have seen a lot higher on some distressed assets. And we also face the problem that a lot of village operators are testing the market. They will run soft campaigns just to test the pricing, but they're not actually committed sellers. So we do run a number of campaigns where, you know, there's no result at the end of it, even though there are offers. I wanted to have a very quick look at the larger portfolios, the Lend-Lease, Stockland, RV, I've put FKP and RVG together, Retire Australia and Australia Unity, because I think this is one of the things I think will drive some of the transactions this year. Just briefly, you can look at their exposure state by state, and I didn't do it unit by unit, but state by state, you see all of them are actually quite heavily weighted in Victoria, which is natural. That's where Lend-Lease and Stockland grew up, and same with RVG. And on that basis, they're probably underweight in New South Wales, South Australia, Western Australia, less of a focus, and differing in Queensland. So what the feedback is and what we're seeing is the larger operators, and I'll go to the next slide, going forward, I think the larger operators will be both buyers and sellers. I think there's a little bit of reshuffling with all of them, and you know, whether it's they're refreshing their product, going for newer product in the marketplace, or getting rid of some stuff that's non-core to them. I can confirm that, you know, all of those groups have talked to us about some sort of reshuffle this year. So, you know, both buyers and sellers, and sometimes I could see a situation maybe sometime this year where there'll be some trading amongst them as well. The not-for-profits always, and I'm sure there's some in the room, they always sort of bamboozle me a little bit. The not-for-profits, some of the stuff that we have, not-for-profits are driven by their members. It's not just commercially driven. So we've ran some processes a couple of years, or the last year we had Greenleaf villages that we put up for market, and that was sold to the Adventist Care Group. Again, they weren't a purchaser that we would have identified normally, but they're on our database. We speak to them when they came up. They were quite strong bidders. And obviously late last year, I think December, Shane, I think it was Watermark Wagga went to Baptist Care. And again, it wasn't someone we would have identified immediately, but we speak to the not-for-profits, and it's a little bit, you know, sometimes stuff I think they'd be interested in, they're not, and other times, you know, they do come from left field and come out and make good offers and do decent transactions. I think that might be it. As we said before, we've got, you know, in terms of retirement villages and aged care, we've probably got closer to 30 mandates at the moment. And look, if you are interested in sort of buying or even selling, you know, we run very good process in terms of confidentiality. You know, our vendors ask us to sell things without telling anyone, which is difficult. But what we have done the last few years is identified, almost like an RSVP.com. We can sort of match make a little bit. When someone comes to us with a product, we can probably identify the top 3 to 5 buyers, which will have a go. So that's our team. Thanks very much, Chris.